All right, today we're going to decode what I like to call the secret language of the market, Japanese candlesticks, and I want you to forget about seeing them as just these complex, intimidating charts. Instead, think of them as the visual language of market psychology, a story of fear, greed, and indecision, all told in simple shapes and colors. You know, every single shape, every wick, and every colored bar on here tells a chapter in this constant battle between buyers and sellers. By the end of this, I promise you won't just see a chart anymore. You'll actually be able to read the story the market is trying to tell you. So here's our game plan. We're going to start with the absolute basics, the single building block, one candle from there. We'll look at bullish and bearish signals, uncover those moments of market indecision, and then we'll wrap up with what is, without a doubt, the most important rule of all: why context is king. Okay, let's dive right in. Look, before you can read the whole story, you gotta learn the alphabet, right? Well, for price charts, that alphabet begins with understanding one single candlestick. If you can master this, everything else will just fall into place. So, what exactly is a Japanese candlestick? Well, think of each candle as a complete story of a single trading session. Doesn't matter if it's 1 minute, 1 day, or a whole week, it packs 4 absolutely essential pieces of information: the price when it opened, the absolute high and low points it hit, and where it finally closed. And here's the really cool part: with just a single glance, the color tells you who won that session's battle. If it's green, the bulls, the buyers pushed the price up and came out on top. If it's red, the bears, the sellers dragged it down and took control. It's really that simple now. Every candle has 2 main parts. You've got the thick part, that's the body, and it shows you the core battleground between the open and close price. A big, long body means one side won, and they won decisively. Then you have the thin lines, the wicks. They show the extremes of the fight. Think of a long wick as the market testing a price level and getting slapped right back down. Okay? So now that you get what one single candle's all about, let's see how they combine to form patterns. We'll start with the good stuff, the bullish signals. These are the clues that suggest buyers are starting to really take control of the market. And first up, we've got a classic pattern. The hammer, its shape is pretty unmistakable, just like its name suggests. And when you see it after a price decline, it can signal a major turning point, like the market is literally hammering out a bottom. So here's the story the hammer is telling you. The sellers try their best to keep pushing the price down. That's what that long lower wick represents. But they failed. The buyers stormed in with so much force that they drove the price all the way back up. It's a textbook signal that the sellers are getting exhausted. Next up is a really powerful 2-candle pattern, the bullish engulfing now. This isn't just a small shift in momentum. We're talking about this pattern can signify a potential tidal wave of buying pressure coming into the market. What makes this pattern so incredibly significant is how that second green candle completely overtakes or, engulfs the previous day's red candle. It's like a visual knockout punch, showing a really sudden and decisive shift from selling to buying. All right. So just as there are signals for a potential rally, there are also patterns that act as warning signs, telling us a price climb might be running out of gas. These are the bearish signals, and they show up when sellers are starting to win the fight. The bearish cousin of the hammer is the shooting star. It has a pretty similar shape, just flipped upside down. But the key here is its location. It appears at the top of an uptrend, and it can signal a potential peak in the price. The story here is really one of overconfidence. The buyers try to push the price even higher and higher. That's what creates that long upper wick. But they reach just a little too far, and the sellers step in and forcefully slam those higher prices right back down. It's a huge warning sign that the buyers might be losing their grip. And yep, you guessed it, just like its bullish counterpart. The bearish, engulfing pattern is a powerful two-candle warning. This time, though, it signals that the sellers are coming out in full force, ready to take over the market. This pattern shows a super dramatic reversal. The buying momentum you saw in that first little green candle, that doesn't just stop, it gets completely overwhelmed and erased by the sellers. In the second candle, it's a very clear signal that the market sentiment has flipped and sellers have seized control. So, sometimes the market isn't clearly bullish or bearish. Sometimes it's just confused. There's this intense tug of war going on, where neither side can get the upper hand. And these indecision candles show us that the market is just taking a moment to pause and think, and this little guy is the doji, because the open and close prices are almost exactly the same. Its body is just a tiny thin line. It represents a perfect stalemate, a moment of equilibrium, where a fierce battle between buyers and sellers just ended in a flat-out tie for the session. But here's the thing, not all stalemates are created equal. These two variations, the dragonfly and the gravestone, actually tell us who is losing strength. The T-shaped dragonfly shows that sellers tried to push prices down but failed. The upside-down gravestone tells the opposite story. Buyers tried to push prices up and were defeated. Both signal indecision, but with a huge clue about who's running out of steam. Okay, everybody, listen up, because this is probably the single most important lesson we're going to cover seriously. Memorizing patterns is easy, but understanding where they matter, that's the real skill. A pattern is only as good as where you find it. You have to remember this. Candlesticks are not a crystal ball. They are a tool for judging probabilities. A perfect-looking hammer pattern that just pops up in a random part of the chart. That's usually just noise. Its true power, its real meaning comes from its location. So this brings us to a super simple but incredibly powerful three-step framework. First, you identify the pattern. Second, and this is the absolute key, you check its location. Is it happening at a price level where the market has reversed before, like a key support or resistance zone? That's where these signals become super reliable. And finally, you wait for the next candle to confirm that the story is actually playing out. So let's bring it all home. What have we learned? Well, every single candle tells a story about the market. Psychology. Bullish patterns show buyers are taking over. Bearish patterns show sellers are getting the upper hand. And dojis show indecision. But the biggest thing I want you to walk away with is this: a pattern alone is just a hint. A pattern at a key location with confirmation. Well, that's a powerful high probability signal. So from now on, when you pull up a price chart, don't just see a bunch of lines and colors. Ask yourself, who's in control right now? Who's losing steam? What is the story that the market is telling you right now? That right there is the key to decoding the language of the market.
Welcome to The Explainer. Today we're diving deep into the secret language of the market, price action. It's the one thing that sits underneath literally every trading strategy out there. And you know what? It's also the one thing most people get wrong. So, have you ever had that feeling you've got a great system, the rules make sense, but you're still losing money? It's incredibly frustrating, right? Well, the source material we're digging into today says this happens because you're just following rules without actually reading the story the market is telling you. You're missing the most fundamental piece of the puzzle, and today we are going to lock that piece into place. Alright, here's our game plan. First, we'll crack the market's secret language. Then, we'll get into the basic ups and downs, the real building blocks. From there, it's the bull versus bear war. Then, and this is huge, we're going to talk about seeing the bigger picture, which is where most traders mess up. And finally, we'll cover the most underrated skill, knowing when to stand aside. Look, a trading system is really just a set of instructions, but understanding market structure, that's like learning how to read. And once you can read, you can pick up any book and get it. It's the same here. Once you get structure, you can make any system work better, or even build your own, because you'll know exactly why you're doing what you're doing. And the source material really hammers this point home. Without understanding the underlying structure, you are trading blind. You're just reacting to price zipping around your screen without any real context. Sure, you might get lucky on a trade here and there, but you won't know why, and that means you'll have no idea what to do when the market inevitably changes its tune. So, how do we start reading this story? Well, it all begins with the two most basic things you can see on any chart, the spots where the price turns around. We're talking about peaks and troughs. First up, we've got peaks. Just think of them as the high points of any given move. It's that spot where the buyers just run out of gas and the sellers starts take over, pushing the price back down. It's basically a temporary ceiling. And you guessed it, the opposite of a peak is a trough. This is the low point of a move. This time it's the sellers who've run out of steam and the buyers step back in and say, all right, our turn, pushing the price back up. It's your temporary floor. Okay, now this is where it all clicks together. Check out this sequence. An uptrend isn't just price moving up randomly. No, it's a very specific dance. First, the price pulls back, but, and this is key, it forms a higher trough. That's step 2. Then it has to power through the old peak, like you see in step 3. That 1-2 punch is the market's way of screaming at you that the buyers are in charge. Now let's build on that with a way more powerful way to think about this. Buyers and sellers is fine, but our source suggests a better framework, picturing the market as this epic battle between two armies, the bulls pushing prices up and the bears driving them down. And honestly, this little mental shift is a game changer. The term buy zone is kind of vague, right? But if you start calling a trough a bull zone, whoa, the meaning is instantly clear. It's not just some price level anymore. It's the bulls' military base. It's their stronghold. This tiny change in wording totally transforms how you see the chart. And this slide just lays it out perfectly. An uptrend isn't just price going up. What you're actually seeing is the bull army defending its territory at higher and higher ground while launching attacks that conquer the bear's strongholds. This is the language of market warfare. Alright, let's get to what the source says is the most critical concept of all. This is where the vast majority of trading mistakes are made. It's our tendency to focus on the little, moment-to-moment battles, while totally missing the direction of the main war. This one sentence right here, this is the key to everything. See, every market has a big, dominant trend. That's the mother trend. And inside that big trend, you have smaller counter trends. Those are the child trends. And you gotta remember, this is fractal. A daily trend can be the mother to a 1-hour child trend. So what does this actually look like? Well, take a look at the diagram. You might see this perfect little uptrend forming. Higher highs, higher lows. That's your child bull trend. But if you zoom out, you see the bigger picture. That entire uptrend you were so excited about is just a tiny little pullback inside a massive, powerful downtrend. That's the mother bear, and believe me, she's in charge. And this right here is the trap so many people fall into. You see that nice little child trend, you followed the rules perfectly, and you hit the buy button. The price pops up a little, you feel like a genius, and then bam, it reverses and just tanks. What happened? Well, your tiny child bull army just charged headfirst into the main fortress of the mother bear army. That little skirmish was never ever going to win the war. Let's look at this specific example from the source. A trader sees this rally here and thinks, great, child uptrend, let's buy. They're expecting it to just keep on going, but they completely missed the bigger picture. The powerful mother bear was in control the whole time, and she was just waiting at this key level, her stronghold, to step in and just smash the price back down. So, the takeaway is pretty clear. Trade with the mother trend, not against it. But what do you do when there's no clear mother trend at all? What happens when the war is just total, utter chaos? Sometimes the market just looks like this, a chaotic, tangled mess. The bulls break a peak, which should be a sign of strength, but then the bears immediately come back and break the last trough. Neither side can get control. The source calls this a period of just random fighting, and there's no clear winner. Trying to trade in these conditions, it's like trying to navigate a battlefield in a thick fog while everyone is shooting in every direction. Any signal your system gives you is pretty much useless. The source calls this a crazy market, and it's basically designed to do one thing: slowly bleed your account dry through a death by 1,000 cuts. And this right here is exactly why having daily profit goals can be so destructive. That goal forces you to feel like you have to trade, even when the market is in this chaotic, unwinnable state. And it leads to that all too familiar story. You make great money when the trend is obvious, and then you give it all back, and then some, trying to force trades when there's nothing there. So what's the professional move? It's patience. Your job isn't to be a soldier fighting every single day. Your job is to be a general. You wait for the fog of war to clear. You wait until a dominant mother trend establishes itself, and then you wait for a child trend to form in the exact same direction. A child bull inside a mother bull. That is your moment. That's when you attack. So the next time you pull up a chart, ask yourself this one simple question. Am I just getting caught up in the child's noise, or am I actually trading with the mother's trend? Answering that honestly will be the filter that saves you from the market's most common and most expensive traps. Have you ever just stared at a trading chart, completely lost, wondering which way the market's actually headed? Well, if that's you, then you've come to the right place. We're going to dive into a professional technique called multi-time frame analysis that honestly just cuts through all that noise and brings some serious clarity, whether you're trading gold or really anything else. Man, this just hits the nail on the head, right? A Reddit user perfectly captured that feeling of being totally buried by your own analysis. You think adding more stuff, more lines, more indicators is supposed to help, but it just ends up making things 1,000 times more confusing. Yeah, I am guessing that sounds pretty familiar. That feeling of looking at a chart that looks more like a modern art piece than a roadmap to a good trade, that's the exact trap we're going to talk about breaking out of today. It's a super common problem, but believe me, you can learn to sidestep it. Alright, so let's call this what it is. It's what happens when you're just lost in the noise. You've got conflicting signals everywhere, you're getting chopped up by the market, and you end up feeling totally paralyzed right at the moment you need to act. Yep, this is what we call analysis paralysis. Your charts are a complete mess of lines, one indicator screaming buy while another is screaming sell, and you're just frozen, second-guessing everything. And here's the kicker. This almost always leads to the biggest mistake you can make, trading against the market's true direction. But look, it's not that you don't know enough, it's that your entire approach is flawed. So, how do we fix it? Simple. We zoom out. You have to see the whole landscape before you start looking at the tiny details. And that's where our solution comes in. Multi-time frame analysis. Think of it as a GPS for your trading. So what is multi-time frame analysis, or MTFA really? It's just a system for looking at an asset on different time scales. You know, looking at the weekly chart, then the daily, then the hourly. It's kind of like buying a house. You don't just look at the front door, right? No, you walk around the whole property, you check out the backyard, you look at the foundation. MTFA does the exact same thing for a trade, giving you that complete 360-degree view. And look, this isn't just some nice idea. It makes a real, measurable difference. The data shows that traders who use 3 or more timeframes see their average win rate jump from about 45% all the way up to 60%. That's not just a little bump. That is a massive statistical edge, and you get it just by changing your perspective. Okay, so we know what it is, but how do you actually do it? Well, pros follow a really simple, disciplined process to keep their emotions out of it. It's called the top-down method. Now this is so important. Amateurs, we often start on a tiny 1-minute or 5-minute chart. We see a little pattern, and we try to make the big picture fit our tiny view. That's bottom up, and it's a recipe for disaster. The pro way is top down. You always start with the big picture, the higher time frame, to see where the market is really going. Why? Because that's where the big money, the institutions, leave their footprints. This one change can make all the difference. And the process itself is literally just 3 steps. Step 1, on your big chart, like the daily, you find the main trend. Is it going up or down? That's all. Step 2, you zoom into a middle chart to find a specific setup that's moving with that trend. And finally, step 3, you use the smallest chart to nail your exact entry and exit. Trend, setup, entry. It's a logical flow, one step right after the other. This is what a lot of traders call the rule of 3. It's a super easy way to remember that each time frame has one specific job. Your higher time frame answers, what's the overall trend? Your middle time frame answers, where's a good setup? And your lower time frame answers, when do I get in? See? Trend, setup, entry. Each one has a simple question to answer. And what's so cool about this is how flexible it is. It works no matter what your trading style is. If you're a swing trader, you might use a daily, a 4-hour, and a 1-hour chart. A day trader, maybe a 4-hour, 1-hour, and 15-minute. The specific times might change, but the top-down logic, trend, setup, entry, it stays exactly the same. Alright, enough theory, let's make this real. We're gonna walk through a simple gold trade to see how all these pieces actually fit together. Okay, step 1, we look at our highest time frame, the daily chart for gold. Which way is it going? It's clearly going up. End of story. Seriously, our job on this chart is done. From this point forward, our brain is programmed to only look for buys. We are completely ignoring any and every signal to sell. Okay, next we drop down to our middle chart, the 4-hour. We're hunting for a setup that agrees with our buy-only plan. And look, we see the price is pulling back into a known support zone. This right here becomes our area of interest. We're not pulling the trigger yet, we're just identifying the location where a great trade might happen. And now we drill down to our entry time frame, the 15-minute chart. Here, we're acting like a sniper. We are waiting patiently for one thing, a trigger. We need the market to show us, hey, the little dip is over and the big uptrend is kicking back in. A strong candle pattern, like a bullish engulfing handle, is the perfect green light. That's when we execute. What we just did there is create something called confluence. It's just a fancy word for when all the pieces of the puzzle snap perfectly into place. All 3 time frames are telling the exact same story. Our daily chart gave us the trend, up. The 4-hour gave us the location, pull back to support. And the 15-minute gave us the trigger, go. When you get that kind of alignment, your odds of success just go through the roof. Now, this system is incredibly powerful, but it's not magic. There are definitely a few big mistakes that can totally wreck the whole process if you're not careful. So let's talk about what to avoid. First, don't use 5 or 6 time frames. Stick to 2 or 3. More is not better, it just brings back the confusion. Second, and listen up, this is the big one. Never let a signal on a tiny chart convince you to trade against the trend on your big chart. That is the cardinal sin of trading. Third, don't wait for a textbook perfect setup. Sometimes good is good enough. And finally, don't let every little wiggle on your entry chart scare you out of a good trade. Trust the bigger picture. So let's kind of wrap all this up by talking about the real goal here. This isn't about learning to be a fortune teller. It's about becoming a strategist who knows how to stack the odds in their favor. And this right here is probably the biggest takeaway of all. Multi-time frame analysis does not give you a crystal ball to predict the future. What it does do is align you with the powerful forces in the market right now. You stop trying to guess what's going to happen and you start trading based on the high probability evidence of what is happening. And the proof is in the numbers. The data shows that when traders only take setups where all 3 of their chosen timeframes are aligned and telling the same story, their win rate can climb as high as 71%. That's the power of trading with the flow, not against it. And this quote just sums up the whole philosophy perfectly. You don't take a trade just because the price hit some line you drew on a chart. You take the trade because the entire market structure, across all your timeframes, is telling you that now is the moment to act. So, I'll just leave you with this one question to think about. Take a good, honest look at how you trade. Are your trades built on a solid foundation of alignment and evidence? Or are they really just based on a signal from a single chart and a little bit of hope? The answer to that could change everything for you. Welcome to The Explainer. You know, have you ever jumped into a trade feeling totally confident that this is the one, only to watch it turn around and stop you out almost instantly? Yeah, it's one of the most maddening things in trading. Well, today we're going to dig into exactly why that happens, and more importantly, how you can flip that frustration into your greatest trading edge. So here's the game plan. We're going to solve the pullback puzzle. We'll learn the critical difference between a simple pullback and a devastating reversal. I'll show you the signs to look for, how to use volume as a lie detector, and then we'll put it all together into a practical trading plan. And finally, we'll talk about a trader's secret weapon, patience. Alright, let's just jump right in and talk about something that I know drives a lot of traders absolutely crazy. Oh man, that feeling, it's just brutal. You see the perfect setup, you place your trade, you're excited, and then bam, the price immediately goes the other way and hits your stop loss. It almost feels like the market is personally out to get you, right? Well, there's a really simple reason this happens, and it's because markets almost never move in a straight line. They have a rhythm, They move up, they take a little break, they move down, they catch their breath, they ebb and they flow. And these little breaks, they're called pullbacks. Think of it like the market just taking a quick breather before continuing on its way. It's a totally natural, totally healthy part of any trend. And once you learn to spot them, they become a huge opportunity. And here's what that looks like on a chart. In a nice, healthy uptrend, you see higher highs and then higher lows. That little dip to form the higher low, that's your pullback. That's not a red flag to sell, that's actually your golden ticket to get in on the trend at a much better price. Okay, so this brings us to the million-dollar question. How in the world do you tell the difference between a harmless little pullback and a full-blown account-destroying trend reversal? This is where so many traders get tripped up. Getting these two mixed up is probably one of the most expensive mistakes you can make. See, a pullback is just a pause, and look closely here. It usually happens on lower, weaker volume. A reversal, though, that's a whole different animal. It's a major shift in direction, and it's usually powered by a huge surge in volume. It's decisive. And this chart just shows it perfectly. See how the pullbacks kind of bounce along the trend line? That respects the overall trend. But that reversal, whoosh, it just slices right through that support, smashing the old trend to pieces and starting a brand new one. Okay, so let's get practical. Let's talk about the actual tools you can have in your toolkit to spot when a pullback is probably running out of steam and the main trend is getting ready to take over again. Look, no professional trader is ever relying on just one signal. It's just not going to cut it. They build a case for their trade. They look for what's called confluence, where a few different tools all start pointing to the same conclusion. So let's look at some of the best ones. Moving averages are absolutely essential, and you shouldn't think of them as just wiggly lines on a chart. Think of them as dynamic, moving areas of support and resistance. In a really strong uptrend, for instance, you'll often see the price pull back to that 20 or 50 period moving average and just bounce right off it as new buyers pile in. Fibonacci levels are another really cool tool. They help us make an educated guess about where a pullback might end. On this chart, you see a big move down, and then where does it pull back to? Right to that 50% level. That's a classic spot where traders who missed the first move are just waiting to jump in and drive it lower. All right, now for my favorite part, let's talk about what is arguably the most powerful confirmation tool there is, because it tells you what the big players are really thinking. I'm talking about trading volume. You gotta think of volume as the market's truth serum. It tells you how much conviction is behind a move. So if you see a pullback happening on really low, fading volume, it suggests nobody's really buying into it. It's a weak, half-hearted move, not a real change of heart. And this slide just nails the difference. A weak pullback just fizzles out on dying volume, right? But a real reversal, that hits like a tidal wave. You see a massive spike in volume and momentum. That's the market screaming at you that something fundamental has changed. Okay, so enough theory, let's make this super actionable. We're gonna put everything we just talked about into a simple 4-step framework that you can use to execute your trades like a pro. A disciplined process is everything in trading. So, step 1, figure out the main trend. Step 2, wait. You patiently let the price pull back to a value area. Step 3, look for proof. A bullish candle, a bounce, a volume spike. And only then, step 4, you pull the trigger with your stop loss already planned. This process takes emotion out of the equation. All right, let's see how this works in the real world with a real stock. We'll use Apple as our example, based on the trade detailed in our source material. So check this out. First, the trend for Apple is obviously up, right? It's above the 50-day moving average. Next, the trader waits for the pullback, this dip right here, which brings the price back to that key moving average. Then they see the confirmation, a nice bounce signaling buyers are back in control. That's the green light to enter the trade, with a clear stop loss just below that recent low. Beautiful. So, before we call it a day, let's just boil all of this down into a few core principles that you can take with you. Look, if you remember anything from this, let it be this. Mastering pullback trading has nothing to do with finding some magical secret indicator. It's all about discipline. It's about having the patience to sit on your hands and wait for those A+ setups, and always having a plan to manage your risk. And really, that's what it all comes down to. That one question separates the consistently profitable traders from, well, everybody else. and learning to truly understand pullbacks is your first giant leap toward becoming the kind of trader who waits for the market to come to them. We've really hoped this breakdown helps you look at the markets with a little more clarity, a better strategy, and a whole lot more confidence.